Hello, I'm here presenting an essay of mine which is pricing and credit strategy, and my learning outcome is the introduction and the thesis statement, discuss the role of cost and demand factors in setting a price, how to price, factor to be considered when pricing and strategy, explain the benefit of credit, factors that affect credit extension and the type of credit, and the conclusion. The introduction and the thesis statement. Every company must determine the price that a customer will be willing to pay for their product or services. Pricing your product correctly can enhance how much you sell. By creating a successful business, pricing and credit strategy, these items are now part of the human life since the abolition of the barter trade, where good being exchanged for goods and services for services, which was very difficult to find a person to exchange with. However, they are of importance to business, government, investors, entrepreneurs, individuals, and employees or workers. In general, pricing is the value attached to a product or services, while credit strategy allow or help creditors or debtors to manage debt and provide them with explore to certain credit and pay in future. Some of the content will be how to price factor. Some of the content will be how to price factor to be considered when pricing, government policy and pricing strategy, how demand and supply affect pricing, as well as its consequence towards the market and how it will reflect on the people as well as the economy. Pricing is a term is used in economics and finance. Many people wonder about price and cost, as well as how to set price. Although the two are used almost interchangeable in business conversation, price and cost are not at all the same. However, both words mean something different when it comes to accounting and financial statement. When conducting any financial analysis, it is important to understand the difference between the two and how they play a part in a financial profile of a company before making any investment or decision. How to price, factor to be considered when pricing. How to price a product. There are various types of pricing strategy. However, there is no one definite formula-based approach that suits all types of products or businesses. Pricing your product typically include considering some main factors like identifying your target customer, understanding the relationship between quality and price, and choose the best pricing technique. The key factor to consider is always your customer first. Some other factors: knowing your customer. In order to get to know your client or customer, conducting some kind of market research is important. This type of research can range from informal survey of your current customer base that you send email along with promotion to more details and potential costly research products that third-party consulting firm are conducting. Marketing research firm can explore your market in a very different way and segment your potential customer by demographic, what they buy, what they price sensitive, like the age, the gender, how many people buy, something like this. Second point to consider is knowing your costs. A basic principle theory, the basic pricing theory is that you have to cover the expenses and then make a profit. This means you need to know how much it costs to sell a product. You also need to understand how much to make of the product and how many to sell to turn a profit. Remember that a product cost is more than the item literally cost. It includes the overhead cost, overhead costs, the fixed costs such as leasing, variable costs such as shipping, the store fee, the cost, the transport, all are included on the cost. That means you're supposed to know your cost. These costs have to be included in your essential. This cost has to be included in your estimate if your product actual before you make a actual cost. Many companies either do not factor in all their cost or underprice or actual in all their cost and hope to make a profit with one commodity and therefore overcharge a good. Another factor is knowing the revenue target. You should target a particular revenue because most of the businesses are running after profit. You will also have to target a budget for how much income the company needs to generate. Take that sales the goal of the organization. Add your development, promotion and distribution cost of your product and you will come up with a price per product you want to charge. If you only have one commodity, this is easy operation. Estimate the number of units you plan to sell of the product in the next year. So divide your target revenue by the number of units you plan to sell. And you have to price your need to sell your product to meet your target of sale and benefit. Moreover, the price of your product should vary according to the number of factors include what the market is willing to pay, how your company and your product are perceived in the market, what your corporation charge, whether the product is highly visible and frequently shopped and compared, and also the estimated volume of a product you can sell. Other important element is to consult potential customer about the view about your goods. So regularly by getting customer feedback on your pricing. Pricing strategy. There are several different methods for setting pricing strategy. Nevertheless, pricing strategy can be complex. The basic rule of pricing are straightforward. All goods will cover both cost and price. Lowering cost is the most effective way to lower the price. Review price periodically to ensure they represent cost dynamics. Marketing demands, competitive response and profit goals. Pricing have to be set to guarantee sales because pricing decisions take time and marketing analysis. Many business owner strategy is to set price once and hope for the best. But for such an approach threaten profit that are not as big as they should be. When is the right time to review your price? When we have a new product or product line launching. When costs change. Decide to enter a new market. Competitors change their price. The economy experiences either inflation or deflation. When sales strategy change or customers are making more money because of your product or services. Some pricing strategy are cost plus pricing, pricing markup, competitive pricing, demand-based pricing. Talking on two, cost plus pricing and demand-based pricing. Cost plus pricing. Many manufacturers use pricing which is cost plus. The point is to being successful with this approach is to make sure that the plus number does not only cover all expenses but also produce the percentage of income that you need. If the overhead figure is not accurate, you risk excessively low profit. The demand-based pricing. A reasonable price for a product or a service is depend on the supply and demand. The two opposite forces always try to find a better balance where the quality of the good or the services provided correspond to the demand the goods or services supply and demand and the demand is a price-determined economy module in a market. It includes that the unit price of a particular good will vary in a competitive market until it settles at a point where the quality demanded by consumer is equal to the quality supplied by the producers, resulting in an economic equilibrium between price and quantity. The four basic laws of supply and demand are: if the demand increase and supply remain unchanged, then it leads to a higher equilibrium price and higher quantity. The second one is: if demand decrease and supply remain unchanged, then it leads to a lower equilibrium price and lower quality. Third, if supply increase and demand remain unchanged, then it leads to a lower equilibrium price and higher quality. If supply decrease and demand remain unchanged, then it leads to a higher equilibrium price and lower quantity. Economics assume that the consumer has a perfect information and is a rational decision maker. Therefore, if a price of a given product rises and the consumer is aware of all relevant information, the demand for that product will reduce. When demand is unchanged, there is an inverse relationship between the supply of goods and services and their price. If supply of a good and services is increased while demand stays the same, prices continue to fall to a lower equilibrium price and higher equilibrium sum of goods and services. Government policy on pricing. Government play a major role in regulating prices and distribution in order to maintain a smooth economy in any nation. To shield the customer interest, the government has to set the price of the product that is usually lower than the equivalent price. A regulation, which can include price control, may interfere with demand and supply in the industry concerned. If a product price are regulated at a higher price in a given sector, it can create an exclusive supply and decrease demand. Companies will be forced to sell such product at a higher price, resulting in more tariff, customer refusing to buy the product because of the higher price. Mandating lower price can lead to a decreased supply and higher demand. In this case, customer will cry out to buy the product, but then if it's more difficult to find the product, as manufacturers struggle to keep up with the rising demand and have less incentive to produce the product because of lower profit margin. The government often use pricing-based policy, which is tax and tariff plan, or quantitative policy such as the cap and trade policy, to implement its supply chain goal in social, environmental, and economic terms, thereby choosing the right tools for the plan is one of the most important factors to successful legislation. Tariffs are usually placed on items imported. Tariff rates also vary depending on the type of goods which are imported. Explain the benefit of credit, factors that affect credit, extension, and type of credit. The term credit is broad with many different meanings in the financial world. In the first and most common meaning of the term, credit refers to an arrangement to purchase a good or service with the expression undertaking to pay for it later. This is regarded as a credit buying. A credit strategy is an actively controlled strategy that offers clients access to some investment grade taxable bond market credit sectors. The approach is ideal for investors willing to bear credit risks, which include local corporates, which taxable bond. The period may be customized to customer goal, while the scope of the sector and security are centered on the business chances. The core credit strategy element to client based on optimizing portfolio sales This approach targets at an attractive level of income while safeguarding the portfolio principal value. Type of credit strategy: we have the conservative, we have the moderate, and we have the liberal. In the conservative policy is a low-risk strategy that restricts credit to only customers with good credit background. On the moderate policy is a mid-risk risk strategy, while a broad credit management policy is the higher risk strategy in which the organization extends credit strategy to most clients. Businesses which seek to achieve higher market share rate, which have higher profit margin, and generally comfortable with liberal credit management policy. We have the pay period. What is the amount of time that is a consumer have to pay? We have the cash discount. If a buyer pays in cash before the end of the discount period, certainly cash receivable have credit standard. We have the collection policy. To conclude, every business or industry need to assess the price the consumer would be able to pay for their product or services, while still keeping in mind the cost of selling the product or services. However, we have been saying throughout our existence, pricing is a process that uses data to eliminate as much doubt as possible to make profit, maximizing decision for key stakeholders. We have learned about the cost plus pricing, competitive pricing, and value-based pricing in depth so far. We learned that the cost plus and the competitive pricing can be useful, but overall we have to discover the pricing based on interest, although it has its own consequences that provide useful data to shrink the data board when done properly, as well as how the government policy affect pricing and credit strategy. Cost and price are two terms which differ but are related. In general, the credit strategies seek to expand credit into the consumer in order to make it easier for them to buy a good or a services. The policy deals the customer payment, makes the transaction more appealing, or split the purchase price into increment, therefore making it easier for a buyer to justify their purchase, while interest in payment may increase the total cost. The benefit for the company is increased revenue leading to increased profit. However, this essential part of credit management program is to decide how to apply their credit to. Extending credit to individual with a bad credit history can result in the good of services being sold not being paid out. This can seriously impact a business. Depend on the business and amount of bad credit that is extended. Business need to determine what kind of credit control policy they want and how to implement. A credit strategy or a credit committee is usually responsible for the administration credit policy for such companies. Accounting, marketing, and sales manager also work together to balance the accommodation credit restraint, aiming to stimulate revenue with a credit sales, but without harming potential performance with the need for bad debt written off. Thank you for listening to me on my presentation.